If you want to pay less tax next year, listen up, because Canada's 2025 tax changes are already in motion, and what you do before December 31st could make or break your refund. I'm talking about new tax brackets, a higher RRSP limit, and a change to EI premiums that'll directly affect your paycheck. Stick with me. By the end, you'll know exactly what to adjust now, so you don't overpay in 2026. Let's start with the headline: Canada Tax Changes 2025. Every January, the government adjusts the federal tax brackets for inflation. This year, they've gone up roughly 4.6%. That means you can earn more before moving into a higher bracket. Basically, you'll keep more of every extra dollar you make. For example, the first bracket now goes up to around $56,500. That's what prevents what's called bracket creep, where inflation pushes you into a higher tax rate even though your real buying power didn't change. It sounds small, but this one adjustment can save the average earner hundreds in taxes. Now let's talk about the RRSP contribution limit for 2025. The new limit is $32,490, up from $31,560 in 2024. That's a decent bump, and if you have extra income or a year-end bonus, you can use it strategically before December 31st to lower your taxable income. Here's the key: your RRSP deduction applies to the year you claim it, but the contribution deadline for the 2025 tax year is actually in early 2026. So planning now, especially if your income fluctuates, can help you decide whether to push your contribution into this year or next. A lot of people miss this timing and end up losing a potential refund. Third, EI premiums are being cut again in 2025. That means a little more take-home pay on every paycheck. For employees, the rate is dropping from $1.66 to about $1.61 per $100 of insurable earnings. It's not a windfall, but for someone earning $60,000 a year, that's around $25 saved automatically. The real opportunity, though, is what you do with that extra money. Instead of letting it disappear into everyday spending, consider directing it to your TFSA or RRSP, because that's how small changes add up to long-term gains. Here's what to do right now before year-end. Step 1. Review your income and deductions so far. Log into your CRA My Account and check how much RRSP room you have left. Step 2. Make sure your payroll reflects the new 14% federal rate that kicked in mid-2025. Step 3. If you're self-employed, this is the time to prepay certain expenses. If you're close to the limit, consider topping it up before December 31st to reduce your 2025 taxable income. Some employers didn't update properly, and that could mean you've been overpaying tax all year. Equipment, professional dues, or insurance, so they count toward your 2025 deductions. Let me give you an example. Suppose you earned $75,000 this year, and you still have $3,000 of RRSP room left. If you contribute before December 31st, you could drop your taxable income enough to save roughly $750 in federal and provincial taxes combined. And if you invest that refund instead of spending it, you're compounding the benefit into the future. That's the quiet trick high earners use. They plan deductions and contributions ahead of time instead of scrambling at filing season. So, to wrap up, the 3 key Canada tax changes 2025 you need to act on are the new RRSP limit, the inflation index tax brackets, and the EI premium cut. Together, they create a window of opportunity to reduce your taxable income, increase your take-home pay, and set up your finances for 2026. Don't wait for tax season. Make your moves before year-end. Check your RRSP room, confirm your payroll adjustments, and make sure you're getting every dollar you're entitled to. I've linked the official CRA and tax tips pages in the description so you can double-check the new numbers. Don't forget to hit that subscribe button.